Hi guys, it's me again. I'm gonna teach you how to prepare a worksheet, which is the fourth step in the accounting cycle, and how to calculate adjustments. So remember what the first step was: analyze, and then we journalize, and then we post to the ledger. And now I'm gonna teach you how to do a worksheet. So, in order to do a worksheet, you have to complete the trial balance of the worksheet first, and you have to prepare the adjustments. So here I'm going to show you an example of a worksheet. Trial balance comes first, then come your adjustment, then your adjusted trial balance, income statement, balance sheet. Complete the trial balance. We've done this before. You enter the balances from the ledger. You transfer the balances over, and then you prove the debit and credits, that the debits equal the credits. And remember to always double roll. You're going to see there's 4 new accounts. These accounts won't be used on the trial balance, they'll just be used when we do the adjustments. Accumulated depreciation, I'm going to explain that to you in a minute. Supplies expense, rent expense, and depreciation expense. Transfer all the general ledger account balances to the trial balance. That's the first thing you do. And that's what I did for you. And then you'll get the totals, and then you'll double roll. So there's the total, 150,500. Okay. Now we're going to enter the adjusting entries. You're not going to like this, but we have to do it. First adjustment you're going to make is for supplies. This is the easiest. The way that you calculate it is that you take the amount of supplies that was, you want to calculate the amount of supplies that was used during the month. So what you do is you take the beginning balance, you minus what's left to get what the supplies expense would be. So how do you record that? Well, that becomes your expense. You debit your supplies expense and you credit supplies because now you're reducing your supplies. If you leave it at this number, 1,500, it's going to be overstated. The next one is if someone prepays something. So on November 20th, Wells Consulting Services paid $8,000 for the December and January rent. As of December 31st, the month has already been used up. So how do you calculate the expense for the rent that was used? What dollar amount was the rent used during December? Well, you take the 8,000, you subtract 4,000, and the amount used is 4,000. So, what would the debit be? The debit would be the rent expense, and the credit would be to prepaid rent because you used some of this. Again, if you keep this at 8,000, your rent would be overstated. The last one is depreciation. Now, depreciation, I'll discuss it more with you in class, is the depreciate the amount the car loses value or the equipment loses value over time. So, every month, like a piece of equipment or a car, the value goes down. So how do you calculate it? What you do is, it's called straight line depreciation, is you take the cost, you minus salvage means what it's worth over its useful life. So what the truck or equipment cost you minus what you could get for it, and you divide it over the number of months of useful life, or it could be years. It depends what. Sometimes they ask for years, sometimes they ask for months. Once you do the math, you would have to, this one had 11,000, that's what the cost was. It had no salvage value, and you divide it by 60 months, that's its useful life, to get what the depreciation expense would be per month. So how do you journalize that? Instead of decreasing the asset directly, the adjustment for depreciation is recorded in an account called accumulated depreciation equipment. They don't want to credit the equipment directly, they credit a contra. I'll talk more about that in class 2. Account. So what you do is you debit the expense, depreciation expense, and you credit accumulated depreciation. Okay, that's it for now, but I'm not done. Well, for now I'm done.